Hey everyone, and welcome back. Grab your favorite pastel highlighters, open up your digital notebooks, and get comfortable because today we've got a really special Study With Me style explainer. We're tackling FAR210, specifically Topic 4, MFRS 102 Inventories. I'll be your enthusiastic UITM lecturer today, and we're going to break down this entire topic into beautiful, bite-sized, perfectly organized concepts. No boring textbook reading here, I promise. We are going to make learning this standard completely painless and, honestly, kind of fun. So let's dive right in. All right, here is our game plan for today. We'll start with a welcome and why we actually care about this stuff, move into defining and classifying inventories, and then calculate the cost of purchase. After that, we hit the golden rule, costs versus NRV, tackle the boss battle of consignment traps, and wrap up with a summary and some top-tier exam tips. These are the official learning outcomes straight from Madame Hafidza and Madame Yusnaliza's excellent notes. By the end of our time together, you'll absolutely master the definitions, calculate costs flawlessly, and just completely dominate the measurement of inventories, especially those tricky net realizable value or NRV calculations. We are making sure you are 100% prepared for that final exam. Okay, part 1, welcome and why we care. Let's start with a really fundamental question. Why do we even bother studying this? I mean, beyond just trying to pass FAR210, right? Why does the real business world care so deeply about counting boxes in a warehouse? Well, it's all about assessing management efficiency. Think about it. If a company runs short on inventory, customers get frustrated, sales drop, and the company's reputation takes a massive hit. But on the flip side, holding too much inventory is super costly. It takes up valuable warehouse space, it might expire, or it could just go out of style. We also evaluate inventory to see if the entity can actually generate cash inflows. Slow-moving stock is basically a double nightmare. It generates lesser revenue and results in much higher holding costs. So proper inventory management is this delicate balancing act, and it's absolutely crucial. Moving right along to part 2, defining and classifying inventories. Okay. Let's lay the groundwork. You might want to mentally underline these next few points because knowing what actually qualifies as inventory under MFRS 102 is literally the foundation for everything else we're going to do today. According to the standard, inventories are assets that fall into one of 3 key phases. First, goods held for sale in the ordinary course of business. Think finished goods ready to be handed to the customer. Second, goods in the process of production for such sale. This is your work in progress, or WIP. And third, materials or supplies to be consumed in the production process or the rendering of services. These are your raw materials. Held for sale, in production, and raw materials. Memorize that trio. Now, listen up because here is a massive exam trap. You absolutely have to know what is not covered by MFRS 102. Work in progress from construction contracts? Nope, that belongs to MFRS 15. Financial instruments like shares? That's MFRS 132 and MFRS 9. Cows, sheep, and agricultural produce at the point of harvest? Say hello to MFRS 141, biological assets. And commodity broker traders who measure their stock at fair value less cost to sell? Yeah, they are excluded too. Examiners absolutely love throwing these into multiple choice questions, so keep this exclusion list handy. All right, let's put that to the test with a quick mini quiz based on a classic exam scenario from your lecture notes. Imagine Joran Kale Buhard, a wholesale company whose entire main business is buying and selling fishing boats. Are these massive fishing boats considered inventories under MFRS 102? Take a second. Think about our 3 pillars. The answer is a resounding yes. Even though fishing boats are these huge, expensive assets, for Joran Cal BHD, selling them is their ordinary course of business. They're held to be sold, therefore. They fit the MFRS 102 definition of inventory perfectly. Great job if you got that one right. Let's hit part 3, calculating the cost of purchase. Time to put on our accountant hats. How do we put a literal price tag on these goods when recording them in our books? Well, you start by adding the basic invoice price. Then you add all directly attributable costs. We're talking things like import duties, unrecoverable taxes, transport, handling, and freight insurance. Basically, any cost that is absolutely necessary to bring the inventory to its present location and condition. But wait, you must minus trade discounts, rebates, and other trade allowances. Please do not forget to deduct those discounts. Let's see this in action with a quick example, like PKP-BHD. The invoice price, transport, handling, and import duties, those are all safely included. Trade discounts and rebates, deducted. But, and it's a big but, look at that bottom category. Storage costs, administrative costs, and exchange losses are huge exam traps. Do we include them? Absolutely not. These are operating expenses, not costs to bring the inventory to its condition for sale. Exclude them entirely from your inventory cost calculations. Which brings us to part 4, the golden rule, cost versus NRV. Seriously, if you only remember one single thing from this entire explainer, let it be this. This is the heavily tested, undeniable heart of MFRS 102. Inventory shall be measured at the lower of cost and net realizable value. Read it, memorize it, sleep with it under your pillow. This is the golden rule. We always compare what we originally paid for the inventory, the cost, against what we actually expect to get for it minus the costs to sell it, the NRV. Whichever number is lower, that is the value we use in our financial statements. Let's see this golden rule in action through a group-by-group comparison. Imagine Group 1. Cost is 600, NRV is 690. The lower number is 600. No write-down needed. We're good. Group 2. Cost is 900, NRV is 1180. We stick with the cost of 900. But then we hit Group 3. The cost is 700, but the NRV has dropped to 660. Because 660 is lower, our closing value must be 660. This forces us to recognize a write-down of 40 ringgit. So overall, our total inventory is valued at 2,160. So the million-dollar question, or well, the 40 ringgit question, what do we actually do with that write-down? Here is a massive exam tip for you. Write-downs are an expense in the year they are incurred. You must add that 40 ringgit to your cost of sales in the statement of profit or loss, and you absolutely must deduct it from your closing inventories in the statement of financial position. Whatever you do, don't leave that 40 ringgit floating in the void. Let's level up with the reconditioned equipment problem. First, let's find the cost. 30,000 for purchase plus 15,000 for work done equals a total cost of 45,000. Next, let's find the NRV. The estimated selling price is 50,000, but we got to subtract the 7,000 it takes to complete it and the 2,000 to sell it. That gives us an NRV of 41,000. Now apply the golden rule. Lower of cost, which is 45K, or NRV, which is 41K. The answer? You advise management to disclose the value at 41,000. See? Beautifully done. Okay, part 5, the boss battle, consignment traps. Take a deep breath, maybe stretch your arms a bit, because it is time for the boss battle. This specific scenario trips up so many diploma students, but we are going to make it crystal clear. Let's look at the difference between a consignor and a consignee. The consignor is the real owner. They retain the risks and rewards, and they record the unsold items as their own inventory. The consignee, on the other hand, is merely an agent. They sell the items just to earn a commission. Because they don't actually own the goods, they never, ever record those items as their own inventory. Let's trace the actual journey of, say, 50 consigned books step by step. Step 1, the consignor sends 50 books over to the consignee. Step 2, the consignee manages to sell 20 books to final customers. Step 3, the consignee recognizes commission revenue for those 20 books sold. But what about Step 4? What happens to the 30 unsold books just sitting in the consignee's shop? Well, the consignor must record those 30 books as their inventory because they still hold the risk and control. The agent doesn't even touch them on their balance sheet. And finally, part 6, summary and exam tips. And just like that, you survived the boss battle. Let's lock all this amazing knowledge into your brain with a rapid-fire review. First, know the 3 parts of the definition: held for sale, production, or materials. Second, memorize what to exclude from the cost of purchase. No admin, no storage, no exchange losses. Third, live by the golden rule: lower of cost and NRV. Remember that NRV is the estimated selling price minus completion and selling costs. Also, do not forget that write-downs are an expense that hit your cost of sales. And finally, unsold consignment goods always belong to the consignor. You are now perfectly equipped to handle this topic. I am so incredibly proud of the focus you brought to this study session today. You just navigated the complexities of MFRS 10 like an absolute pro. As you head off to crush your practice papers, I want to leave you with this final thought. When you face your next tricky inventory question, how quickly will you be able to apply the golden rule to secure those full marks? I know you're going to do great. Keep up the fantastic work, stay motivated, and good luck on your FAR210 exams.